Good evening. Call to order the Finance Committee meeting for Thursday, February 9th. First action item, approval of the minutes from the January 12th meeting.
I'll make a motion to approve the January 12th, 2023 minutes.
Second.
Any discussion? All in favor?
Aye.
Next item up, Clifton Larson Allen, an update from Nicoletta McTeague. Welcome, Nicoletta.
Thank you. Good evening, everybody. I see I have it here on the screen, the presentation, so you guys
Yes,
looking at
we got
this?
it.
We have it.
Yeah,
You
okay.
have desk monitor.
This one's going to be on there, I assume.
Yes. I'll just watch it. That's why I don't need these.
I'm just going to try the mouse for a minute. Sorry. The other mouse works, Mama.
Yeah, you like that better.
Okay, good evening, everybody. Thank you for having me here. I'm going to go over the audit results. Here, the first slide is the agenda. I will go over the terms of engagement, an executive summary of the financial results, and the federal and state single audit results. I'll go over a couple of slides for financial highlights, and then I'll go over the programs that we audited for the state and federal single audit, followed by governance communication. As you know, required communication from the auditors to those charged with governance. And last slide is has listed the upcoming GASB pronouncements. Terms of engagement. So we were engaged to the audit of the financial statements to provide an opinion on whether the basic financial statements are presented fairly in accordance with GAAP, generally accepted accounting principles. Also, we were engaged to give an opinion in relation to the financial statements, the basic financial statements related to the schedule of expenditures of federal awards and schedule of expenditures of state financial assistance. In addition, we were engaged to do a state and federal single audit, and as part of those audits, we are required to express an opinion on compliance of the major federal and state programs that we tested, and provide an internal report on internal control over financial reporting and compliance with laws, regulations, contracts, and grants, and provide an report on internal control over compliance related to major federal award programs and state major program. So basically, a bunch of reports that we issued at the end of the audit. The important slide, the executive summary of the audit results on the financial statement. We issued an unmodified opinion on the basic financial statements, which is the best opinion that you could get on the financial statements. Included in the in the report was a paragraph, emphasis of matter paragraph, to inform the reader that we, or the town, implemented GASB 87 leases. And the town had both situations where the town was lessee for some agreements and lessor in the others. So GASB 87 requires that town report lease receivable and deferred inflow for those agreements where the town is a lessor, and for the and those agreements have to be long-term, meaning over 12 months. And for those agreements where the town is a lessee, the town is required to report right to use assets and lease liability for contracts of right to use the assets. They are longer than 12 months. So the town successfully implemented the GASB 87, and the emphasis is, again, an emphasis of matter paragraph is to alert the reader of the change in the financial statement. As part of the audit, we issued the internal control over financial reporting over financial reporting, and that report was clean. So usually that will be the report where if there are any significant deficiencies or material weaknesses on control over financial reporting, that's where they will be listed. But that report is clean, which means that we did not identify any findings related to internal controls over financial reporting. On the next slide, This is a summary of the governmental activities, and that is the same schedule that you will see in the MD&A, the Management Discussion Analysis, where it gives a comparative 2 years worth of amounts, even though financial statements are not comparative, but this kind of gives a better picture of the governmental activities of the town for the year in comparison to prior year. Governmental activities include all funds of the town with the exception of pension and trust funds. So general fund, special revenue funds, capital project funds, they're all reported in this schedule, and they are on full accrual basis, which means that you'll see capital assets or long-term assets and long-term liabilities are here. Which are not included in the governmental fund. So at year end, governmental activities ended with a net position of $36.4 million, which was a slight increase from prior year of $36 million. In the next slide, I included the governmental funds, which is a statement of revenues, expenditures, and changes in fund balance. So total total fund balance for all governmental funds at year end is $10.5 million, and included in that is $5.8 million of general fund. So each column in this exhibit is what is called a major fund, and all the other funds that do not qualify to become major funds that have their own column in this exhibit are included under non-major governmental funds. So as you can see from this slide, the fund balance increased in total for all governmental funds by $2.8 million to, as I said, $10.5 million. And general fund actually had a decrease of $1.2 million. So in the next slide, there is a breakdown of the fund balance for the general fund. So as you saw from prior slide, fund balance for general fund at year end was $5.8 million. And included in that is an assigned of $1.3 million, and breakdown further of that assigned fund balance is $450,000 for subsequent year's budget and $865,000 assigned for encumbrances, and that's combined for town and Board of Education, with the remaining number being unassigned fund balance of $4.5 million at year end. As far as the budgetary highlights go for general fund, general fund revenues were $686,000 under budget, and this number excluded the amount of the use of fund balance that was reported as a revenue for the budgetary column. Included in the general fund revenues were property tax collections, which were $397,000 under budget. Collection rate continued to be at 99.7%, so it's very close to what was in the past also. As far as the expenditures go, general fund expenditures on budgetary basis were $375,000 below budget. On the next slide, I have a summary of the activity for the year of the pension and OPEB funds. So there's included in this column are 4 pension plans and 2 OPEB, about 1 OPEB fund because one is unfunded. So for the year, the net position of pension and OPEB funds combined was $73.9 million, and that was a significant decrease of $17.2 million from prior year. So net position went from $91 million to $73 million, and the majority of that, the main reason for that is a decrease on the value of investments. So as we all remember, June 30th, 2022 was not a good day to report your investments and to report on all other stuff investment related. So the main reason for the decrease is the reduction on the fair value of the investments at year end. So that, because that is a snapshot of the value of the investment in a given day, which is the year end, June 30th, 2022. On the next slide, I included some other information related to pension and OPEB. They're all in the financial statement, but this information, I took it from the notes of the financial statements. At year end, the town reported a net pension liability of $17 million, and prior year net was net of pension liability, and the net pension asset was actually an asset of $3.2 million. So out of the 4 plans, general employees, police, firefighters, and ambulance, this year they're all reporting a net pension liability. Last year, 2 of them had asset and 2 of them had liability, just because of the way the numbers ended up at year end. So as you can see, the funding level for the current year is anywhere from 57.62% to 84.5%, and that is a significant decrease from prior year. Where in the prior year, general employees and police officers were over 100% funded because they reported a net pension asset, and firefighters and ambulance were about 68% and 85% respectively funded. So again, because of the way those numbers are calculated at year end, where you go total pension liability less net position of the pension trust funds at year end, if the net position of the pension trust funds go down, the funding level will go down also. And hopefully June 30th, 2023, we'll report better number on investments, so the number will hopefully go up. But I just wanted to explain why there was such a big difference between level of funding last year and this year, and because of the way, the investment went down by so much in the
Can we ask
fiscal
a
year 22.
question during this?
Yeah,
Oh,
yeah,
sure.
anytime.
So just on this page, the percentage at the bottom, is there a target range we want to be? Does it differ by the type of pension, whether it's employees or police or what have you? What are we kind of trying to be at in that percentage?
Obviously, the higher the percentage, the better. I don't think there is a target.
Oh, there's not like a specific bogey we need to be within to be compliant or anything?
No, there's no required per se, like by the state statutes or laws or regulation. No, there's no certain percentage. That's depending on town's finances and what the actuary tells you the liability is going to be and how much you need to contribute. Really, your goal should be that you contribute 100% of the actuary determined contribution. But then, nobody has a crystal ball. You can't see what those numbers are going to be as far as the investments go going forward. But your target should be to follow your policy regarding contributions to the plan.
And the actuarial suggestion as far as what to contribute is not necessarily going to get you to 100% in those either, right? That's not necessarily what they're trying to accomplish.
So they I'm not an actuary, so I hopefully I'm not talking out like something that's completely wrong. But they, when they give you the numbers, they go through this long projection of this is what you need to be now to be okay for for the life of the plan or. What it is, and again, I step always back. I don't want to talk actuary language because I know I'll mess it up at some point. But basically, you ask if there are any targets. My recommendation will be to follow your policy of contributing 100% of your actuary determined contributions, and then you'll not get yourself in trouble.
Okay.
Nicoletta, along the same lines, is there, because you do municipal audits as a regular, is there a benchmark between where we are versus other municipalities that you audit? Are we within line with others, or?
You are.
Okay.
Yes, so you are probably we go on the curve towards the top of it, yes. There are very few municipalities that are close to 100%. But you were at 100% last year, so if your investments do better next year, you'll probably go back there again. So you're not in the lower end, if you will. You're probably in the top 1/3.
Okay.
Because as you said, we see a lot of towns and their numbers, so then this is a decent funding level. Well, yeah.
That's a good answer.
Yep.
I imagine we can surmise, again, this was a snapshot as of last June 30th. So just based on the
Correct.
performance of the market since then, we can assume that these numbers are kind of obsolete on the low side at this point.
Correct.
Okay.
Yep.
Notwithstanding today's performance.
I didn't see today's numbers.
Haven't checked my
Don't
markets today. Oops. And as far as the OPEB liability, there are two plans, one for the town and one for the Board of Ed. The town plan is funded, but the Board of Ed plan is not funded, so it's pay as you go. Town plan reported $17.2 million in liabilities at year end, and the percentage of funded that is 13.46%, which is actually, since you asked me the question where we stand, is kind of low. As far as Board of Ed goes, they had $1.2 million of unfunded liability at year end because they do not have a pension or OPEB trust fund to fund their future liabilities for OPEB. And obviously, looking by the numbers there, their liability is smaller, and because they have less participants than the town has in the plan.
If I just have, and this may be more for Mona, right? So this chart, this is just for defined contribution plans, or rather defined benefit plans.
Defined
benefits,
Defined benefits,
yes.
right, okay.
Yes.
Defined contribution is wherever it gets put in.
What they
it
invest
what it
is what
right,
they-
right, okay.
Yeah, the town doesn't report any liabilities for defined contribution,
Right,
so
right.
in the notes, what the town discloses is just how much employees and employer contributed to the plan, and how many participants are in the plan. There's no liability to the town other than just contributing the amount every year to the plan.
Great, thank you.
And the next slide, this concluded my high-level summary of the results of the financial statement audit. And then the next couple slides, I'll go over the federal and state single audit. So the town spent $6.7 million in federal awards. And based on our risk assessment of the expenditures, the federal-related expenditures, we selected two programs to test as major programs. The first one is the Education Stabilization Fund, or ESSER, like everybody refers to it as ESSER, and the second one is the ARPA Fund. So these were the two, both programs were considered high-risk programs because they were marked as such by the federal government. So they were audited as major programs for the year, and the results of our audit were clean. We expressed an unmodified opinion on major program compliance requirements, so we had no findings as far as compliance goes. Similar with internal control over compliance of these federal programs that we tested, the report is clean. We did not identify any deficiencies related to those controls over compliance requirements. So all good, they're clean. The next slide, I put some information regarding state single audit. The town spent $8 million in federal and state awards, and of that, only $1.8 million was subject to testing. The rest is considered exempt by the state of Connecticut. And based on our on our risk assessment, we identified two programs as majors and tested them. One is Town Aid Road, and the other one is Tiered Pilot. Again, the results of the audit, similar to the federal single audit, was clean. We expressed an unmodified opinion on major programs compliance, and we did not identify any deficiencies related to internal controls over compliance requirements. So good news there, too. In the next couple slides is the auditor's communication to those charged with governance. The first one, the first section of the letter that you all received has to do with qualitative information. During the year, the town, as I mentioned before, implemented GASB 87 leases, included in that section of the letter is a section related to significant deficiencies that are significant estimates that are included in the report. So this is to make you guys aware that the numbers in the financial reporting include some estimates. So that if the estimates were any different, those numbers could have been different. So the significant estimates that are included in the financial reporting have to do with net pension liability and net OPEB liability. So the actuary goes through their calculation assumptions and calculates the liability, and we audit the assumption, make sure that they are management has to approve those assumptions, and that we have to make sure that those assumptions are they make sense for the town and they're in line with what's going on. The third one there is the incremental borrowing rate. So that was used to calculate leases receivables, payables, right-to-use assets, and lease liabilities. So since most of those lease agreements did not have any stated interest rate in them, so the management had to come up with an incremental borrowing rate, so which is usually the rate of borrowing when the bonds are issued, when the contract was done, and all that. So that, again, that's an estimate, and if the estimate goes up or down, those numbers could have been up or down from what they are reported. Another estimate included in the report is but in the report is the depreciation expense, which is as a result of estimating the useful life of capital assets. Allowance for uncollectible receivables and incurred but not reported liability related to the insurance claims, this is for the Board of Education, are the next significant estimates that are included in the report. Next slide. We did not have any disagreements with management. We are not aware that management consulted with other accountants for second opinions. We did not have any difficulties didn't encounter any difficulties in performing the audit, and there were no uncorrected misstatements to report. So as far as the uncorrected misstatements, sometimes we find things that, management decides they're not material enough or they're not going to book. We did not have any of those to report this year. And there were no independence issues, so we were able to do the audit. So we can't do the audit if we are not independent. And in the next slide, I have listed the GASB standards that are going to be applicable for 2023. I bolded Statement 96 because that's the one that will apply, and town will have to implement for the year. So that's the subscription-based information technology arrangements. This statement is going to be very similar to GASB 87 leases, but applies only to software agreements the town has. So if the leases were for agreements for non-financial capital or non-financial assets, this one covers only the software agreements the town and Board of Education and all departments that might have. Similar to 87, that will apply to long-term, meaning more than 12 months, agreements are for more than 12 months. So Mona's aware of that. Similar to GASB 87, an inventory will be created, and then we'll go through that, and an analysis will happen to determine if or which agreements are going to be subject to GASB 96, and they will be implemented. So basically, the net result is going to will be a subscription asset in the books, and then there will be SBITA is the short term for subscription-based information technology liability. So it'll be an asset and liability in the government-wide financial statements. It's not going to be an entry at the fund level. And then last slide has my contact information should you need to reach out to me and have any questions related to audit. That concludes my prepared presentation.
Questions?
I think I asked all of mine already.
Thank you.
No, Mona, congratulations keeping the ARPA compliant, because I know that was a moving target throughout the process, so.
It was a very
Congratulations
thorough
doing that.
review as well.
Yeah, and we'll probably be audited for the next couple of years.
Yeah.
Yeah.
We're ready.
Yeah.
Excellent. Thank you for coming in.
Thank you.
and
Thank you
giving
for
us the
having me.
information.
Mona, somebody will take care of this?
Yeah, they'll get it.
Okay, thank you.
Keep moving through item number 3, discussion 2022 grand list. Welcome, Stuart.
I'm not the biggest fan of the audit process. They're very thorough.
Just like the tax assessor, I understand.
And Mona doesn't miss a thing.
I don't.
Not that I try and do anything, just, the I's are dotted and the T's are crossed. And therefore, it trickles down to our level and makes sure we do that as well. I assume you have the handout.
Yes.
The grand list grew 20.1 million, about 0.88%. With the biggest increase with the motor vehicles at 18.6 million, mostly on the commercial vehicle side. There'll be some residents out there that are not very happy with their car assessments again, but it's supply and demand, and the market dictates what the assessment is. Real estate went down, mostly because of Walmart and our healthcare facility at 1160 Elm Street. The judge ruled against us in both cases. Well, he split the difference. I think he was wrong, but they make a decision, I can't control it. And then personal property was up 4.3%. The biggest with that is the Riggs and Distler. They're at the end of Laurel Road. They did a significant reinvestment, as well as Connecticut Pharmaceuticals down on Dividend. They did not. They increased their investment in town, but they also didn't file for their exemption, so they did not receive it. So those are the biggest reasons why we had an increase this year.
So what exemption are you referring to, Stuart?
They are eligible for a manufacturer's exemption. I did everything I possibly could to get them to comply. And, I gave them the extension, which was under the law. I called them, we emailed them multiple times, and, like with any other person that's eligible for something, we try and, we chase them down to make sure they get it before we sit there and say no. But once I sign the grand list, there's really nothing I can do now. They have the right to appeal if they choose to, but they don't really have a appealable case. But these are the highlights of the grand list. Any questions or concerns?
Is this kind of typical for a non-reval year as far as the change in the, I know we had the 0.4% decrease because of those court cases, so that's a little bit of an anomaly, but.
Yeah, that's the anomaly. These last 2 years with motor vehicles are anomaly as well. With the scarcity of new and used cars really has driven up the value of them. But usually we have an increase in motor vehicles because people are constantly buying new vehicles, getting rid of their old ones and stuff like that. Personal property usually goes up each year by a little bit. Historically we're somewhere around between 0.75% and 1.5% increase, depending on what the actual growth and happening in town is. So, this coming year, the way we value motor vehicles is going to change. If you look at the legislature, there's like 20 or 30 bills out there specifically on motor vehicles, whether it's to delay the implementation of the law they passed last year, whether to get rid of motor vehicle taxes completely, to there's a bill out there that says that, not to allow us to assess a car more than we valued it the year before. Even if we were wrong on how we did it, you can't change it. So there's a lot of legislation being proposed that are going to affect the citizenry here if it's passed, and not necessarily in a positive way.
But it's important to note that that's totally out of the town's hand. That's all state.
Oh,
They
absolutely.
determine how you calculate it, what values you use, where the values come from, what books are used, and so.
That is all driven by the state of Connecticut and the Office of Policy Management.
So I know last year when, like you said, the motor vehicles went up, a lot of people were like, what's the town? It's like, it's not the town.
You know,
Hands are tied, it's at the state level.
Well, and as soon as I saw it, I came, I talked to the mayor, I talked to the town manager, Mona, and I said, look, this is what's going to be the issue. This is going to be your biggest complaint. And it's because, I drove by the car dealership the other day and there's like no cars on the lot. Whereas a couple of years ago, there was hundreds. So,
Part of that's speculative to what happens at the legislative level, but the piece that's not, there's a change coming next year to
Yes.
commercial motor vehicles, or commercial vehicles that is part of the law of how they get reported.
unless they postpone the law,
Right.
right now, the motor vehicles will be valued, residential motor vehicles, code 1 and 3. That's your combination plate is 3, code 1 is your passenger plates, will be valued based on MSRP, and then a depreciation schedule that has been set by the legislature. Commercial motor vehicles will be valued as personal property. So if they keep the law the way it is, you'll see a large increase in personal property because all those commercial vehicles will be shifted over. And you'll see a drastic reduction in residential or the motor vehicle grand list.
So that will be the individual businesses will have to report that on the personal property return? It won't be flowing through the motor vehicles the way it does now?
Correct, it'll be valued based on their cost,
Right. So it's,
theory.
so that makes it subject to them to report correctly versus coming through motor vehicles, which I'm familiar with, only picked up the chassis cost, not necessarily any of the
well-
add-ons.
We do a pretty good job of getting the whatever the attachment is, but sometimes we don't necessarily get it right. But for the most part, we do. But they will have to report that, and then it'll be auditable. So if we audit them, they will have to show us what they actually paid.
So the question I was going with it, Stuart, is what additional work does that create for your department now that it's coming through a different channel?
I think it's going to be a nightmare for us. The quantity, it's all going to be how much into the weeds we want to go with it. And how honest the taxpayer is. We do audit taxpayers now, and some of them are very honest, and some of them not so much. But it's going to review, especially with this year with a revaluation year, it's going to be, because it's new, it's going to be a real challenge for us because we have to learn the new law. OPM really doesn't know how to, doesn't have guidance for us how we're going to administer it yet. So there's a lot of the questions we've asked on the law. They have not given us guidance on which way we should handle things. So we're waiting on guidance from that. And I'm not expecting any guidance to come until probably July or August or even September. Especially with all the bills in the legislature that are still, waiting to be determined on which way they're going to go with things.
So piggybacking on that real quick is, because it's going to become personal property from a tax perspective, are we going to be better or worse, same? Let's just assume everything gets reported like it should. We'll take that part out of the equation. I mean, I don't know what the rate is versus one versus the other.
Well, I think the town would be, it would be favorable because it's a higher mill rate.
That's, yeah, okay.
Yes.
All right, it's a higher mill rate. On the other hand, at the moment, it's a higher mill rate, but we have revaluation this year. So I don't have a crystal ball. I can't tell you what next year's mill rate is going to be.
Right.
There's a proposal in the law this year that reduces the mill rate on motor vehicles to 26. So if that passes, you'll be again constrained again on on your on the budget process next year. So not knowing the answers to those questions, not knowing where the market's going to be in 10 months from now, it's hard to say what but it'll definitely change, put more value into the personal property side. And again, for certain motor vehicles, they're exempt for the first 5 years, and they haven't explained to me how this new law affects that, and so.
A lot of variables.
If something's not broken, I don't think you should fix it. And, Connecticut has one of the best, and I know people don't necessarily agree with it, but truly has one of the best tax systems in the whole world. We really do. It's an ad valorem tax. People don't like it. But it is the fairest in the world on how we assess property. If you go to California, you could have two houses right next to each other, and the tax amounts are astronomically different just based on when they purchased it. And then they have all these exemptions for the transactions and stuff. And here, at least, it's market value, and we value every 5 years and set it. And it's truly, I truly believe it's the fairest in the world on how we do things.
Bill, did you have a question? also?
Yeah, I did. So circling back to something I thought you said, Stuart, with respect to non-commercial vehicles, you said it's changed to a system where it's initially assessed based on MSRP and then followed by a depreciation schedule? Did I hear that correctly?
Yes, they're saying it'll be 20, it starts at MSRP, and then over 20 years it depreciates. I haven't seen the depreciation schedule yet, but at the end of 20 years, there's a flat assessment. And
Okay, you
some say it's this, some say it's this.
Just
and
made my question. I was wondering how long the depreciation schedule is going to
20
be. So
years.
20, okay, so we're not going to miss too many cars then. Only the ones that
Oh,
people drive
yeah.
for more than 20 years, but that's probably not a major number.
Well, it depends on what the depreciation schedule is.
Right.
But it starts at MSRP, and prior to COVID, the MSRP was always significantly higher than what people, would pay. And that would be my biggest complaint is, I didn't pay that for my car. And it's like,
So it's MSRP as of when? If this new system is kicking in?
it'd be as of October 1st every year. So on the year you bought it, so you buy a 2023 car.
Okay,
It's whatever the MSRP would be as of this coming October. And then that's what your value would be for the next, that would be your base value for the next
right.
forever, really. And then it depreciates from that value.
So these market fluctuations we're seeing now, they
would
get taken
be-
out of the equation.
Would be taken out of the equation.
Now, how about when someone buys a used car?
It would still go by the MSRP.
So MSRP based
That-
on
The
okay,
original.
the published retail value for the used car.
Yes,
And
at
then-
the time that it was new.
And then the depreciation schedule, the number of years will be reduced based on the age of the car, I guess.
So if you bought a 2015, Honda today, it would still go back to that original MSRP and be depreciated, even if you paid below the market value for it.
Oh, so if today I buy an 8-year-old car,
It doesn't start at that cost, it starts at the MSRP, and then it's at the 8-year depreciation from the MSRP.
oh, I see. I thought it was Blue Book value for the used car as of now when I buy it. You're saying you're going back to the historical MSRP when it was new,
Yep.
8 years ago, and then you run the depreciation from that.
Mm-hmm.
And we don't know yet if that depreciation is straight line or if it's going to be.
It's a fixed schedule, it is.
Okay.
They briefed it briefly, and it's still, again, OPM hasn't sent it out yet.
But I guess the value of this, though, is it avoids that kind of sticker shock that people are experiencing on their tax bills when we had this odd spike of used car prices went up and their bills go up. Now it's predictably, year by year, it's going to go down. Well, subject to the mill rate, obviously, but as far as the valuation is concerned, that's not going to spike up.
Correct.
Okay. So I have a question on an entirely different topic, and going back to the real estate. So except for that odd situation of these two major properties that got revalued based on court decisions, if you took those out of the equation, if they had stayed flat, how would we have done on the real estate side this year?
We'd have been up about $6 million.
Okay. So we ended up going down 6 million, so the net effect of those two court decisions was minus 12? Okay.
For the most part, yeah. Well, there's other deductions out there because if people take something away from their house or, we had a couple large fires in town for houses and stuff, we reduced the values, but essentially, yes.
Okay. All right, thanks.
Anything else for Stuart? No.
Yep.
Thank you, Stuart.
Oh, you're welcome. Have a good night.
You too. Where were we? Assessor, item 4, discussion possible action, tax refund.
And I'm going to request that we table this to next month. We, as I think Stuart was alluding to, one of these is affected by one of these settlements that he just got results from not too long ago. So we're going to go back, and unfortunately, this will be a larger refund. So this is a refund that's due for overpayment. We'll probably be coming back in March to do the refund plus settlement due on that. So I'd like to table that and make one payment for the next finance meeting.
Okay. So do we have a motion to table?
Make a motion to table item number 4 on the agenda regarding tax refund.
Second motion.
All in favor?
Aye.
Move on to 5. That was a quick one. This one won't be. Discussion defined benefit plan validation.
So what I have given you are probably the more important pages of each of the defined benefit plan actuarial valuations. We get them every 2 years. We've just gotten this one for the 22 year. It takes them a number of months, obviously, to get it to us. We received this information in January. I have summarized it on this one page, so feel free to read the narratives that go with it, but I think I have recapped the more important pieces of information to show you where we are. Again, I've listed the 4 plans: fire, ambulance, the general plan, and then the police plan. And again, these are all just defined benefit plans only. So you'll see, I'll compare the July 20 to the July 22. So 7/1/20 is the last time they did the actuarial valuation for us. And I'm showing those first 2 lines is where the assets were, 7/1/20 and again 7/1/22. So as you look across, you can see that there were variations in there. For the most part, we had growth over the 2 years, but as we know, we're talking to the auditors, we had the downturn at the end of the year, and we're also seeing some progress moving upward. I haven't gotten the last quarter's information, so I can share that at a future meeting. So we're watching the assets fluctuate. Next, I wanted to point out, and again, auditors had mentioned this, was that percentage of funding ratio. And as she was mentioning, the variation from the 50% to the 85%, I wanted to show that where we were on that last valuation for 7/1/20, that we were at, for the larger plan, the general plan and the police plan, very close to 100%, and we have dropped since then. Combination of the contributions, which I'll discuss in a minute, as well as the change in the assets. So they kind of go hand in hand and affect that percentage.
Can I ask a quick question about
Yeah.
that?
mhm.
So the percentages here differ from what Nicoletta gave us. I know this is at July 1st or June 3rd. I'm guessing that's not the issue.
No, and they're preparing this, although it's their effect on July 1/20. It's something that they're accumulating, and we do get it in January, so I think you see a bit of that fluctuation. But they're trying to do the snapshot of assets, so I think what they are giving to the auditors for June 30 may vary slightly as they continue to do the whole valuation process. So there is a bit of a time gap in there.
So is the numbers you provided what we should be focusing more on versus what Nicoletta gave us, or?
I would say for this purpose, since we're looking at valuations, and this is what your actuaries are going to use to direct you to fund this in the future, will use this because this is going to be the actuary's valuation plan. We will own this plan for the next 2 years. So, to do the audit and close out on June 30 was their responsibility at that point. Now they're giving us the valuation of how should we move forward. So for this purpose, we want to stay with this.
And Mona, just one, I'm trying to remember dates in my head and it's not working. We made changes to the fire and ambulance pension plan, probably somewhere around 2020.
Correct.
And in 2021, we actually made a change to the police pension plan.
Yes.
And so we have two, if I understand it right, we have two things happening. We have changes that happen to the plans, plus the market value of the investments have changed.
Correct.
And, so, okay, saying that, though, that actually makes me less, not that I'm even concerned because these numbers aren't bad, but that explains why we see a change in the
Exactly.
numbers, and the funding levels may not have to change because of the time. I mean, that's the actuarial piece, but the time
Right,
to
there are a few
compute it.
pieces playing in that. Yes.
Right.
Yes, yeah.
Okay, thank you.
Yeah, and I think as I'll go a little bit further on, so let's look at that, for example, the actuarial determined contribution.
Okay,
Right? I continue.
yeah, you keep going.
All right. So the actuary determined contribution for the 7/120, and I can go across for each plan. You can see for the fire was at 167, and now this year for the 2022, 171. So as you said, there were some changes in the fire. The changes in the plan itself was, for fire, was not as dramatic as, for example, the ambulance. If you recall the changes that occurred in the ambulance plan, they were making changes in recognizing the titles of the individual employees, or not employees, the volunteers, and also the amount they were being paid. The ambulance had, and I'm probably be a slight bit off, but they had, for example, $50 per year, and they were trying to mirror more so what the fire had. So something that was a $50 per year became more of $150. So although the ambulance is a smaller group, you see toward the bottom the number of lives affected by this plan, 199 in the fire, and a smaller group being the ambulance, the 75 to 68. They had a slight decrease. So it's a small group. The change was small, but you'll see that changes in the actually determined contributions. I'm going to jump over a bit to the general plan, and so that plan did not change. However, if you follow along that column, the 7/120 contribution determined by the actuaries was $464. This year it's $269. Result of that being, for the most part, is the number of members. We've had a number of retirements. So at the bottom you can see from 311 to 302. That change in retirees has that much of an impact on a plan that's closed. So,
And are new employees going to a DC plan?
correct. This
So
plan
that-
is closed.
so over
Closed
a
in
long period of time,
2016.
that'll keep.
Right, you'll see this
They go up, yeah.
drop as the more retirees you have. I think important,
But also, you're going to have a decline in contributions then, though. That's the flip side of that.
correct, that's right. Yeah. I think what I needed to point out on following down in that general, for the budget payment for 21-22, now again, to keep in mind that the July 120 contribution was recommended for $464,739. That following budget year, we had budgeted $214,739. And I know the auditors conveniently, because she was here earlier, was talking about how we should fund at the 100%. In that particular year, that was not budgeted at the 100%, the 464. It was the 214 for the 22-23 year. It should have been 464 to be 100%, and we had budgeted 405. Not as dramatic of a change, but those type of situations is what will also affect you going from 104% funded to the 91%. It's not the only item, But as we were told, and as the actuaries say, this is what they would like us to see funded at that level. So when we receive this amount for the 7122, we should be budgeting what's required. Fortunately, for the general plan, it is a lesser amount. On that, I will go to the police plan. So, yes, as you had mentioned, we made a change. We reopened that plan. It was closed for 2016, brought back the police officers out of the defined contribution plan, put it into the defined benefit. Fortunately, I showed at the assets where that larger increase. The defined contribution employees were expected to put in and did their contributions, as well as the employer portion. That was about $350,000 that was contributed. We actually did the transaction probably around September of 22, but it was still recognized as revenue in this 7122 year because it was a signed contract and it was a timing issue. So that actually worked very well for us, recognizing that transaction, because what it did do is for the 7122 make those assets higher. I think if we had seen that $350,000 transfer in this year that actually the cash transferred hands, you would probably see a much lower funding ratio in there and a much higher actuary determined contribution. And I know it's probably a lot, so if I need to keep going, or?
No, you lost me there. So
That's okay.
We're referring that, so we had this brief window where police were on defined contribution and not defined benefit. And that was only for, I guess, for some new hires, right? And so
Correct.
for a period of time, they were paying in for defined contribution. So once we got back to defined benefit, what happened to those funds? Did those individual accounts get rolled over into a defined benefit plan of some
They went
fashion?
straight into this defined benefit.
So that's how the transaction you're talking about was,
Exactly.
it kind of rolled over.
Right.
And so, and on the defined benefit plan, the officers are required to make some contributions, I take it?
They still do percentage of pay,
Okay,
correct, 5%.
so the officers who for a period of time were making contributions for, defined contributions, those end up being credits toward the contributions for the defined benefit plan.
They get years of service, they'll continue to pay a portion of their pay.
But the money they paid-
They're individual dollars, and I think that was one of their agreements that they had. So if I had put in a certain percentage of my pay in a defined contribution, now those monies that I put in, as well as the town's portion, which was the match, those dollars went into this defined benefit plan, and it is no longer associated with the employee. What the employee gets is the years of service, because the defined benefit plan is not calculated on contribution. It's calculated on year of hire, year of service, and your average pay. So that was one of the agreements when they had done this transfer from defined contribution to defined benefit, was all contributions would go into the plan to fund the transfer.
So you have Officer X who contributed, $10,000 during the period of time that it was defined contribution. When you flip back to defined benefit, as I understand it, then you took that $10,000 and you equated that to a certain period of service, X number of years, and said you're going to get credit, you're going to get the years of service equivalent to that contribution?
No, what they would get would just be recognized in a defined benefit plan with their year of hire. So the
It's like a
dollars,
retroactive.
yeah.
Well, I guess my question is, so the person who
They
put in
do.
that $10,000, did they just lose the 10,000 or how?
Let me try
Yes,
to.
yes, basically it became a contribution to transferring into a defined benefit plan,
Bill.
which for them ultimately in retirement would be a better paying retirement. Right. When they are in defined contribution, they would be receiving their contributions at the end of retirement by putting those funds in to fund this change, which was the agreement to the change, that they would now be getting retirement based on salary and years of service, which ultimately would benefit the
Let
employee.
me try to simplify it if I can. You as an individual put $10,000 into your defined benefit plan, a defined contribution plan,
Contribution.
and you worked 5 years for the
Right.
town. You're going to get credited for those 5 years, and your $10,000 just went into the pool.
So did they all put in the same percentage of their pay? I mean, because.
Yes.
Oh, okay.
Yes.
I guess
Same
that was my question,
percentage of
'cause
pay.
Like in a 401K,
Yes.
you can put in nothing or 1% or whatever,
no.
and so different people in different situations. So it was fixed numbers per officer anyway.
Correct,
Okay,
correct,
that's-
yes.
okay, that's what I
yeah,
was unclear on.
yeah.
Thanks.
The only slightest variation would be if somebody wanted to be aggressive in investing and did well, then they would probably lose that edge.
Okay, got it.
But percentage of pay, same.
Okay, thank you.
So, okay, so with that, again, those funds were recognized, the transfer in happened in the 7/122 number, the 1.27 million, it's rather than the 903, shows that 350 came in. Needing to point out, and this will affect our upcoming budget process, so the determined contribution for July 1 of '20 was 903,000. Now, having these new members, down toward the bottom, they went from 58 members now to 76. We've added the 20 plus employees into this new plan. The contribution per the actuary says we will now need to fund 1.2 million, 1,273,000. If you look at the budgeted amount for 21-22, instead of the 903, which was recommended, budgeted was 249. For the 22-23 year that we're in, rather than the 903, we did 762. In following recommendations of the actuaries, and you've heard from the auditors as well, we should be funding at the required determined contribution. So for the police would be the $1.2 million, $1,273,000.
Wait, Mona, and I may have just missed it.
That's right.
The recommended contribution for July 22 was 1.273,
Mm-hmm.
and the budget was 762,000.
Correct.
Okay, I thought you said 249. That's
It was in the prior year.
the prior year, correct? Okay.
Yes, so we
So
basically,
we were-
we underpaid in 2 years, so it's time for us to do the right 100%. With that in mind, the contribution in next year's budget, 23-24, for pension contribution would be 510,000 higher than what our existing budget was. Fortunately, I'm backtracking a little bit, the offset for the general, because it decreased, would be a savings of the 135. So I wanted to present this to give us a sense of where we're going with the budget for pension contributions for next year. Should be the net of all of those lines across. I should have totaled them, but it will be the 510 less the 135. So we should be looking at about a $300,000 increase if we were doing 100% of the contribution.
375.
Yeah.
So a lot of changes, brought some new members in, gave them the defined benefit, and I mean, ultimately, that will be the impact on that line item for the future year.
Okay.
So, a lot of numbers, a lot of conversation, but if you have any other questions, I'm open.
I don't think so.
I'm set, thank you.
Any other items on the pension, or I know you got a lot
No,
more
I
slides.
think that was the
so-
highlight.
That's the
Yeah.
high level? All right, we like the
Yes,
high
yes,
level.
and like I said, the backup are just the pages that follow through with the numbers
Okay.
pulled forward on the summary.
All right, then we'll move on to the update for the special revenue fund. So on this particular summary, you can see this is through the period through January 31st. I've highlighted some areas. We had in the last month, again, that insurance loss. I'm still waiting for my reimbursement on my streetlight. So that fund will actually increase with the revenues coming in to match up to the expenditures. Asset forfeiture, still working with the police department on uses of that particular fund. We also should see some increases in revenues on that as well.
we've had a bit of a backlog on the processing of this from the asset forfeiture funding agency. Hopefully, we have more revenues coming in. Then on human services, just pointing out, it's particularly as we're getting ready for the budget process, working with Human Services Director and on the best use of the available balances in comparison to needs for the 23-24 year. They've got some plans for that we should be able to share. On the ARPA, the Fund 21, we requested last month to separate out the fire, because fire was in with the Fund 21, so you'll see that twice. The ARPA line with the $3.8 million in there, and the fire calls, the $14,000. That still continues to grow, and the fire chief and I are working on tracking, having a system of tracking as the bills are going out, that they're actually being paid. So although it's at $14,000, let's see, the last conversation we had, he had billed over $30,000 on that already. So the turnaround is a bit slow.
And on the fire, do we know what the number was we needed to fund? I believe it was their radios was going to come out of this money set aside. Do we know what that number was that they had requested?
I don't recall. I don't recall.
Okay, I'm just curious if we're
I can
getting,
get you.
if we're getting close to that number, so
I think we're getting
start
close.
the process.
Yeah.
How do we get this oddball number of 14,654? I thought each payment was a round number like 500 or 750.
They did. Pardon me? No, they are at 500. When they had first started up, there were some miscellaneous revenues that they had, so they've got a couple of smaller items in there, reimbursement for actual cost. So it will be, and they are now exactly $500 every time.
So when it first started, it wasn't that exact?
No, they were trying to get collections for miscellaneous calls rather than this regular $500 per call. So I think when it got more systemized and we're doing the reimbursement, so this was their first collection. It was probably from not necessarily the state. I can pick that one off.
Oh, so this account isn't necessarily limited to the state reimbursement for the I-91 stuff?
It is. I think we have a small little piece from a previous fire call collection in there as well.
It got
So
rolled
this is-
into this, okay. But
Yeah.
going forward, it's just the
Absolutely.
the I-91 stuff?
Yes, yeah. And those are the highlights for special revenues.
Any questions on special revenue? No? Jeff? Good. All right. Reserve for capital and non-reoccurring expenditure fund through January 31st.
Okay. Again, this is through January 31st. It's obviously a lot of numbers, not a lot of activity. For the most part, we're seeing the number that's changing is on the Board of Ed. It's a small number, it's $9,000, but that is what's paying for the rotating SRO position. So other than that, the other numbers were there at the previous month with no change.
I'll assume we're good to move forward on that.
Yep.
State aid to municipalities.
State aid, we received our January payments as we had hoped and planned. We received the final town road aid, $175,000, and we received our second ECS payment, $1,444,000.
So everything's right on track.
Right on track, nothing behind.
And if we're good here, we'll move forward to the monthly financial report.
Okay. On the monthly financial, I have my executive summary. I will actually jump to the second page, which is the tax collectors, large revenue source. You can see that that is at 94.5% compared to last month at 96.7%. In comparison, we do a 3-year average benchmark, the lower half, which would say on a 3-year average, we would be through the January at 87.3, we're at the 94.7. So to kind of clarify what we're looking at, on an average, we would be at around 87%. because we are slightly behind in comparison to last year at this time, it's really an effect of what's the average is. I'm watching this one kind of closely. We are expecting that it is the timing of payments coming in because they close off on January 31st. Mail has been horrific. Sorry, postman, but the tax office was actually waiting like at least 3 days out, finding tax payments that were postmarked for the 31st. So we were closing the books for the 31st, but still seeing those payments that are coming through. There'll still be not interest applied to those because if they're postmarked for the 31st, you're still on time. So I am hoping that this variation, the 94.5 versus 96.7, is a timing issue, and we'll have a better idea where we're standing after the end of February. With that said, revenues in general are in a good place. Again, we'll keep watching the tax. The tax sale is still in progress. We are at 10 properties that actually made it to the legal notice level, and we are looking at $215,000 to be collected. All others made payment plans or came through with payments, so we came down to 10 properties, and that is still scheduled for April.
And is that 2 more that came off the list since our last
Yes,
meeting?
yes, they came in for some final payment plans.
Great.
Yeah. Interest still continues to be very high, and conveyance, again, because of that early payment in the year that gave us the high percentage, is still making us favorable. Building permits are actually very good, 78% compared to 60% where we were last year. So hopefully we'll see that trend continue. As far as expenditures,
Actually, one quick question on the
Yeah.
revenue. Solar energy, is that just a timing? We got a
it
one-time
is,
payment
they
type of
come
thing?
through in June. They always wait to the last week of June as well.
Great, thanks.
Yes. Expenditures, you can see the overtime tends to be a little bit high. We haven't had snow, but we've had ice events and various situations bringing highway out, and we're still looking at the vacancies at dispatch as well. Fuel continues to be a bit on the high side, 78%. As far as electricity, we actually just received, so it's not in this financial report, but we're starting to see the effect of the new rate increases, and we're going to be working very closely on that to see where we are. We seem to be doing well on usage, so perhaps the impact of the rate increase will not be as bad as we imagined. We've had our facilities departments doing a great job with managing the light usage, and I don't want to steal his thunder, but he's got some great monitoring and controls in place. I think I had marked out the food. You'll see that's an overage in this particular report. That's for the senior lunches. That will be just a transfer that's going to be done into the special revenue fund. We do the allocation of $75,000. Anything above becomes part of their special revenue. So she had some overages, and we'll be transferring those off to her collections next month.
And just worth noting that they just increased their lunch rates.
Yes.
So,
Yes.
you know,
Yeah.
I think Ed reported that at the last
Yeah,
council
lunch
meeting.
and special events, I think,
Yes,
evening events.
yeah, so they're aware of it and they're making adjustments, so.
Yes, they did a great job, actually. The directors, and I looked at her, their spending and the average costs, and, she did a great job, being on top of it and finding out that, some of the paper supplies was, causing an impact. So I think she's gotten ahead of it very well. So a lot of supporting documentation, and very good job on that. Health insurance, keeping an eye on that one. It's our first year doing a minimum premium, which is a bit different for us. So we do our minimum premium, but we also pay off some claims. So the activity of claims has an impact, although it has a cap loss. If you have somebody that had an issue, 250,000. So we're starting to see it peak, I think, a little earlier in the year than expected. So watching it, but I don't know if it may exceed the budget line, but not to any extreme at this point. And Board of Ed did come through with December 31st numbers within a 30-day turnaround, and I think we should be timely with them for the future. And that is the highlights of the monthly financial.
Any specific questions? No? Okay. Do we have anything for other?
I do not.
Seeing none?
Motion to adjourn.
Adjournment.
Second.
All in favor?
Aye.
Thank you, everyone.